Ken kind of walked through the economy, and the two things that drive the stock market, it's pretty simple. It's earnings and priced earnings. And so we're going to dive in and hit earnings first. So what's going on with earnings? Earnings up and to the right. This goes back to 1980. This year, as Ken said, over 20% earnings growth. Next year, 9%. And now 2020 estimates are for 10%. So up and to the right, everything's going great. So obviously Santa is going to take us to the new highs for this year. But as we know, by watching the market, that's not what's happening. So if it's not earnings and everything's great there, what is going on? It must be priced earnings. So what's happening with the valuation of the market? You've seen this before. This is the rule of 20. So the blue line is what the market has been, and the red line is what it should be. So you can see that blue above red, that was the tech bubble. So the alligator jaws opened up, and then they closed the not fun way. The market went down a lot. The blue line went below. The alligator's jaws opened up the Great Recession. And they closed the fun way over the last 9 years with the market appreciating. And now we're just kind of bouncing around. Last year when we met, we said for the first time in 9 years, the market was a little bit overvalued. Today, it's about 12% undervalued. So we've been bouncing back. So the good news is we have a little bit of a shock absorber back in the market, which is healthy. What we really like is dissecting this. We've never really done this before. If you dissect this chart, so the PE of the market right now is 15, and it should be 17. But the 15 is an average. There are some above it, and there are some below it. And we like to use the analogy, if you put your head in the freezer and put your toes in the oven, your belly button is average temperature. And what we're seeing right now is the freezer and the oven are as far apart as they've been in 20 years. There's a big spread between what people are willing to pay for these and not willing to pay for these. And so we'll use an example. Ameren UE, they're helping keep the lights on in here. So Ameren UE is about a 4% grower. Very steady, very predictable. The market's growing 8 to 10%. The market's trading at 15 times. So what would you guys pay for $1 of Ameren UE? 21 times. So you're getting 15 for the market, growing 8 to 10. People are paying 21 times for $1 of Ameren. That is the highest since Argent's been around. So that is the freezer. People are loving the predictability of Ameren, so they're hiding in that.